think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero, you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable. But who cares about let's say 2 quarters of stagnation or a little bit of negative? I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues.
97% of investors are making the same devastating mistake that will cost them their financial future. And if you don't know what this mistake is by the end of this video, you'll be one of them. In the next recession, and trust me, it's coming sooner than you think, this single error will separate the wealthy from the broke, the winners from the losers, the prepared from the desperate. Listen, if you're serious about building real wealth and not just surviving the next economic storm, but thriving in it, then you need to watch every single second of this video. Don't you dare scroll away or get distracted, because what I'm about to reveal could be the difference between retiring wealthy or working until you die. If you're ready to think differently than 97% of people, if you're ready to stop being a victim of economic cycles and start profiting from them, then hit that like button right now and let's dive in. The pattern that destroys wealth. Throughout history, there's been one pattern that repeats itself over and over again. It's not new. It's as predictable as the sunrise. Every single economic cycle, the same drama plays out, and yet most people fall into the exact same trap every single time. When markets crash, when headlines scream economic collapse, when your neighbor loses their job and your portfolio gets cut in half, there's this overwhelming urge that takes over. It's primal, it's instinctual, and it's absolutely devastating to your wealth. The biggest mistake people make during a recession isn't a technical analysis error. It's not picking the wrong stocks or timing the market poorly. The biggest mistake is thinking with their emotions instead of their brain. They get trapped in what I call panic tunnel vision. When assets crash, fear hijacks their decision making. They see their 401k shrinking and think, this is it. It's all over. I need to sell everything now before I lose even more. But here's the brutal truth. By the time you feel that panic, by the time the fear is overwhelming, you're already making the mistake that will haunt you for decades. The human brain versus the market machine. Let me explain something that most people don't understand about how your brain works in a crisis. Your brain was designed to keep you alive. On the African savanna 200,000 years ago, when a lion appeared, the survivors were the ones who felt immediate terror and ran. Those who stopped to analyze and think rationally, they became lunch. That same fight or flight response that kept your ancestors alive is now sabotaging your financial future. Because markets aren't lions. The economy isn't a physical threat. But your brain doesn't know the difference. When you see your portfolio drop 30%, your ancient brain screams, danger, escape, sell everything. It floods your system with stress hormones that make rational thinking nearly impossible. But here's what your panicked brain can't see. The economy operates like a machine. It has predictable cycles. Credit expands, spending increases, income grows, which leads to more credit expansion. This continues until debt becomes unsustainable. Then the machine corrects itself through recession. Recessions aren't random disasters. They're necessary maintenance cycles that reset the system, like forest fires that clear out dead wood so new growth can flourish. The people who understand this machine, who can see beyond their immediate fear, are the ones who build generational wealth. Everyone else, they become the fuel that powers someone else's fortune. The clarity trap. Here's another brutal truth that most people can't accept. Clarity comes after opportunity has passed. Think about it. When do markets look safe to most people? When they've already recovered, when unemployment is falling, when earnings are growing, when everyone feels confident again. but by then, all the best deals are gone. The stocks that were trading for pennies during the crisis are now back to full price. The real estate that was selling at massive discounts has already been snatched up. The market doesn't wait for you to feel comfortable. It rewards those who act when everyone else is paralyzed by fear. I want you to think about every major market bottom in history. March 2009, March 2020, October 1987. At the exact moment when stocks were cheapest, when the buying opportunities were incredible, what were the headlines saying? Financial apocalypse, worst crisis since the Great Depression. Markets may never recover. The news is always worst at the bottom because that's when fear is highest. But markets are forward-looking machines. They don't care about today's headlines. They care about where things will be 6 months, 12 months, 2 years from now. The linear thinking illusion. Most people suffer from what I call linear thinking syndrome. They take whatever's happening right now and project it straight into the future as if nothing will ever change. GDP drops one quarter, they assume it'll drop the next quarter too. Unemployment hits 8%, they think it's heading to 15%. Stock market falls 20%, they're convinced it's going to fall another 20%. This is the thinking that destroys wealth because markets aren't linear, they're cyclical. They overshoot in both directions, up and down, because of human emotion. What linear thinkers miss is that the system has built-in correction mechanisms. When things get bad enough, policymakers act. Central banks cut rates. Governments deploy stimulus. These aren't random acts. They're predictable responses to predictable problems. Every major recession has been followed by policy responses that eventually restore growth. Not because politicians are geniuses, but because their political survival depends on it. When unemployment spikes, they get voted out unless they fix it. The investors who understand this pattern position themselves to benefit from the fear of linear thinkers. While everyone else is selling in panic, they're buying at discount prices, knowing that the policy cavalry is coming. Second-order thinking, the billionaire's secret. Here's what separates billionaire investors from everyone else. They think in second and third order consequences while everyone else is stuck on first order thinking. First order thinking, company earnings are falling, stock price must fall. Second order thinking, earnings are falling, which means the Federal Reserve will likely cut interest rates aggressively, which will make borrowing cheaper, which will eventually stimulate investment and spending, which means this company's stock is probably oversold right now. The wealthy don't just see what's happening now. They see the chain of reactions that follow. They understand incentives. They know that policymakers have powerful tools and strong motivations to prevent economic collapse. When COVID hit in March 2020, first-order thinkers saw lockdowns and panicked. They sold everything. Second-order thinkers saw lockdowns and thought, this will force the Fed to print trillions of dollars and cut rates to zero. Asset prices are about to explode. Guess who made fortunes and who lost them? Second-order thinking also means understanding forced selling. During recessions, many investors don't sell because they want to. They sell because they have to. Margin calls, redemptions, risk limits. This forced selling creates opportunities where prices disconnect from value. The disciplined investor with cash and second-order thinking sees these dislocations as gifts, not threats. The stress test opportunity. Recessions are like X-rays for the economy. They reveal which companies were strong and which were just lucky. During good times, rising tides lift all boats, even the leaky ones. Easy credit, abundant liquidity, and general optimism can keep weak businesses alive for years. But when recession hits, it's like a stress test that separates the truly strong from the pretenders. This creates incredible opportunities for those who know how to analyze businesses. While panic sellers dump everything indiscriminately, the prepared investor can pick up shares in exceptional companies at fraction of their true value. But you have to be selective. Not everything that's cheap is a bargain. Some companies deserve to fail. The key is identifying businesses with strong balance sheets, competitive advantages, and capable leadership that can not only survive, but emerge stronger. Think of it this way. Would you rather buy a luxury car when everyone wants one and prices are sky high, or when there's a temporary panic about luxury cars and you can get a Ferrari for the price of a Honda? Recessions create Ferrari for Honda prices moments in the stock market, but only for those who can think clearly when everyone else is panicking. The preparation principle. Here's what most people get wrong about recession investing. They wait until the recession hits to start thinking about strategy. That's like waiting until the hurricane makes landfall to board up your windows. The wealthy prepare during good times for opportunities that will come during bad times. This means maintaining liquidity when others are leveraged to the hilt. It means staying diversified when others are concentrated in whatever's hot. It means studying history and understanding cycles when others are just chasing trends. Preparation isn't just financial, it's psychological. You need to condition your mind to see crashes as opportunities, not disasters. You need to build emotional discipline so you can act when others are paralyzed. Most people do the exact opposite. They take maximum risk during good times and minimum risk during bad times. They buy high and sell low because they let emotions drive their decisions. The prepared investor does the reverse. They're cautious when others are greedy and aggressive when others are fearful. The cycle advantage. Understanding cycles gives you an almost unfair advantage over other investors. While they're reacting to news, you're anticipating what comes next. Every expansion contains the seeds of the next contraction. Every contraction sets up the next expansion. It's not complicated, but it requires thinking beyond the immediate moment. In 2006 to 2007, when everyone thought real estate would rise forever, cycle-aware investors were preparing for the inevitable crash. In 2008 to 2009, when everyone thought the world was ending, they were buying assets at generational lows. The pattern repeats because human nature doesn't change. Fear and greed drive the same mistakes over and over again. Those who study these patterns and position themselves accordingly can profit from the predictable behavior of the masses. Mastering the inner game. The hardest part of recession investing isn't the analysis, it's the psychology. Having the emotional strength to buy when everything looks terrible, to hold when everyone's selling, to think long-term when short-term pain is intense. This is why the wealthy spend so much time on mindset training. They know that all the technical knowledge in the world is useless if you can't execute when it matters most. You need to develop what I call emotional detachment from market movements. Your portfolio's daily fluctuations shouldn't affect your mood or your decision-making. You need to see markets as probabilistic systems, not as reflections of your personal worth. Most people's emotions are perfectly correlated with market prices. They feel great when stocks are up, terrible when they're down. This emotional roller coaster guarantees poor investment decisions. The wealthy investor's emotions are inversely correlated with market prices. They get excited when stocks crash because they see opportunity. They get worried when everything's going up because they know it won't last. The wealth transfer mechanism. Here's the harsh reality. Recessions are wealth transfer mechanisms. They don't destroy wealth. They move it from the unprepared to the prepared. Every major recession creates new millionaires and billionaires, real estate moguls who bought distressed properties, stock investors who accumulated shares at discount prices, business owners who expanded when competitors were retreating. The wealth doesn't disappear. It changes hands, from emotional sellers to rational buyers, from the panicked to the prepared, from the majority who think with their hearts to the minority who think with their heads. This isn't evil or unfair. It's the natural result of different approaches to uncertainty and risk. Some people see crisis as danger. Others see it as opportunity. The outcomes reflect these different perspectives. So here's your choice. You can be part of the 97% who let emotions drive their financial decisions, who panic when markets crash, who sell at the bottom and buy at the top. Or you can join the 3% who understand how the game really works. The next recession is coming. It might be next year, it might be in 3 years, but it's coming. The question isn't if, it's whether you'll be prepared to profit from it or become another casualty of your own emotions. Start preparing now. Build your cash reserves, study market history, develop emotional discipline, learn to think in second and third order consequences, master the inner game of investing. Because when the next crash comes, and it will come, there will be incredible opportunities for those ready to seize them. Life-changing, generational wealth-building opportunities. But only for those who do the work now, while times are good, while thinking is clear, while preparation is possible. The choice is yours. Join the 97% who get crushed by cycles, or the 3% who profit from them. Your financial future depends on what you decide to do with this information. Don't let this be just another video you watched. Let this be the moment everything changed for you. If this opened your eyes to how the wealthy really think, smash that like button, subscribe for more wealth-building secrets, and share this with someone who needs to hear it, because knowledge like this shouldn't stay hidden. Your future self will thank you.